Hello and welcome to Pro Trader Strategies Market Commentary for Friday, February the 1st. It's Unenjoyment Friday, the first Friday of the month where we get probably the most important data point of the month, and that is in the form of non-farm payrolls. But let me get a couple things out of the way real quick. My name's Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, though, I am here to teach you some different strategies that you can then implement into your portfolios, but please do that in your own way. Also, remember, past performance of any trading system or methodology is not necessarily indicative of future results. All right, having that out of the way, let's get it on with some economic data. It is Unemployment Friday, which is, like I said, what we called on the floor Unenjoyment Friday because it usually turned out to be a kind of a crazy day. Anyway, let's get on with some economic data across the pond. They did come out with a bunch of manufacturing PMI data points and stuff like that. All of them pretty close to being in line with expectations and or what we had seen already in their flash estimates. Now, their flash PMI numbers are their most important data points. They did come out with some PMI numbers today, but it's kind of a rehash, and they're in line pretty much with what we had seen before. So let's talk about Great Britain, though. They did have a manufacturing PMI number coming in at 52.5, expected to be 53.5, slightly lower than expected. But remember, these PMI numbers, anything above 50 is expansion, anything below 50 is contraction. We got Consumer Price Index, which is CPI. Flash estimates out of European region came in at 1.4, which was in line with expectations. The core CPI flash estimate, which strips out like food and energy, came in at 1.1%, higher than the expected 1%. Then here in the United States, we got our average hourly earnings, came in at 0.1%, expected to be 0.3%. Obviously, we'd like to see that number start ratcheting up as it shows wage inflation to drive some of this economy going forward. That is slightly higher, but not anything major, to be quite honest. And then the non-farm payrolls employment change came in at, 304,000, expected to be 165,000. So much better than expected there, almost 140,000 better than expected there. They did revise last month's number down from 312,000 to 222,000. So that revision, major revision, 90,000 almost. So that makes that headline number still good, but not quite as rosy as it first initially looks on the headline number. Then we got the unemployment rate upticked a little bit to 4% from 3.9%. You'd think with full employment and being very close to full employment that we would start to see that percentage go down. But what happens is when people start seeing the economy start to turn, they start coming off of the discouraged workers line, which basically is not claimed as unemployment because they are not claiming unemployment anymore. So therefore, they're not a part of the data point. When they come back into the workforce looking for a job, that's when they come back online, and this unemployment rate will have a tendency to uptick for that. All right, then we got our ISM manufacturing PMI came in at 56.6, higher than the expected 54.9. So nice number there. And then we got the ISM manufacturing PMI came in at 56.6, expected to be 54.1. And then we also got the University of Michigan consumer sentiment coming in line with expectations at 91.2. Wholesale inventories here in the United States ratcheted down just a bit, which is good. That means they're moving inventory, came in at 0.3%, expected to be 0.5%. We also got consumer spending upticking a little bit to sorry, my eyes are bad, 0.4%, expected to be 0.3%. And then ISM manufacturing prices came in at 49.6, expected to be 54.9. So prices coming in lower. Usually, for economic points, they think that is bad. I think lower prices, especially right now, is a good thing. So to me, that's not bad. And then inflation expectations 2.7%, and all day long we get vehicle sales. So keep your eye out on that. Phil LeBeau is a good one to follow for those vehicle sales on Twitter. All right, let's talk about the overall markets. We've got crude oil continuing to try to trudge higher today, again by almost $1, trading at 54.71. We've got gold coming off a little bit. I talked about this yesterday. I thought it was a little bit overdone to the upside, especially with the way that the equities were gaining strength. That flight to safety being the pull out of equities and into gold should be over. We see the sector rotation coming out of gold and into equities is what I was expecting. It looks like that's starting to show up a little bit today as gold is coming off with the equities moving higher. Bonds giving up all of yesterday's gains today. Again, the market has priced in bonds being where they are. That is appropriate for interest rates not going any higher, and they don't have a whole lot of room to move on either direction. Once they got extended a little bit over to the upside, being they tried to settle above the value area high, that's just way too fast, way too overdone. They did retest it, and I think we're going to come back down to the point of control now at this time. Remember, I put on that GDX short yesterday, which is the gold miner index, and it should follow with gold if it's moving down. All right, the VIX is coming off. Looks like those 20s are well behind us now at this point, with the with the Dow Jones Industrial Average is up over 100 points right now. We settled above this Fibonacci level that acted as support yesterday and the day before. Today, not really testing that, but getting a little bit overdone to the upside. I think it might even test this value area high before we start rolling back over towards this point of control. We've got the NASDAQ right at the point of control, settled there yesterday. I talked about this a lot in detail over the last couple of weeks that I was expecting it to come to the point of control and start to settle down. We'll see volatility come out. We're starting to see some of those things happening now. We've got the E-mini S&Ps testing that value, point of control again today. As yesterday, we settled right at it. Today, it looks like it was more of a flush out of some weak hands. If we look at the daily chart, you can see overnight inventory pretty flat, but we started rallying on the open on that unemployment number, got slammed almost immediately thereafter. Seeing a little bit of a recovery, but at the end of the day, inside day, not a whole lot of volume. We had a couple of big moves on that data point, but the market really just trying to figure out direction at this point. I haven't added anything or taken anything off. I'm letting my IWM GDX kind of meld a little bit before I take those off. They're not really even close to 50% of my max profit. They're profitable, but just not anywhere close to where I want to start to look to cover those. So I'm going to be kind of on the sidelines today looking for some opportunities. That being said, that's all I got for you guys. I hope you have a great weekend. And if you can't take that, take it easy.